India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a fresh new week. It's a week from the 20th of January, President Trump's inauguration. It's about 3 weeks away from the union budget. But, you know, if you expected that there will be some calm before the storm, there is no calm before the storm. I mean, of course, we're calling 20th as the storm, not the budget. But there is no calm. In global markets, forex markets, bond markets, I mean, it's upheaval out there. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning, folks. Plenty of headlines and, you know, pretty difficult headlines to go over internationally. But I want to hold on to the silver lining. It's Monday. We have good data in the form of IIP here back at home. Yep. And, of course, this big Gala UP event, the Kumbh kicks off today. And, you know, religious tourism is becoming so huge. And you have a lot of the A-listers, Bollywood A-listers, Hollywood celebrities who are about to descend on Prayagraj. And I think that's the visuals of the first Snan as it comes through. So perhaps, I mean, in terms of being a major contributor to the state's economy and to putting, you know, India once again on the world map, this is definitely an event that the world is watching out for. A lot of infrastructure development has happened in the region. I have some family in that region as well. So the reports that I get from the ground is that some mega infrastructure development has been on for the last couple of days. We hope the event just goes off peacefully. It's a long one, all the way up to February. So hoping for the best. It's all eyes on UP.
I think this happens once in 10 years, right?
No,
so
this is the big one. This is the Mahakumbh. This is I think, once in over a century, I think. It's that one.
Oh, wow.
Yeah.
I mean, that's, Okay, all right.
All right, and very happy Lohri as well to all our viewers who are joining, and happy Lohri to both of you guys as well.
Absolutely.
You know, a special feeling. I mean, my in-laws as well will be celebrating it, so it's a big.
I can tell you, but Delhi Memories is a big festival up in the north. The time to be happy and sort of joyful and hopeful about the future as well.
Absolutely, and I think we've all kind of celebrated it being in Delhi, of course, for the majority of our lives. But, you know, we got the big one, which is the market, which I think is a spectre of red, right, across the board. And let's just quickly rewind the clock and start by telling you the cues. It all started, of course, with the blowout US jobs data, which came through. And this came on Friday, it comes around the time the US market opened, and it was a big blowout number. So very strong. It is basically what is done is naturally reduced the need for interest rate cuts. I mean, so the bets were already deepening that Fed will perhaps cut only twice. Now probably it's down to one, according to many. Now the number itself, the December jobs number, 256,000 increase compared to 165, which was the consensus. So, you know, that is a 100,000 beat. You got unemployment rate 4.1 compared to 4.2, so it's dropped. Lesser sort of unemployment out there, and average hourly earnings, another important metric, was absolutely steady. So these are the numbers. What the consequence of all of this? Most large mainstream banks, global banks, have shifted their Fed forecasts to fewer or later starting cuts, right? I mean, some are saying maybe June, some are saying later, some are saying maybe not in 2025 at all. So Bank of America, by the way, is one of those banks, and I wanted to just, there are many, and we'll put out more views. They are no longer expecting any cuts in 2025. And they're saying that the next first move from the Fed from here will probably be a hike, not a cut. Now, that is a dramatic U-turn that we've seen coming through. The markets now, S&P was down 1.5, Nasdaq was down 1.6, and the Russell 2000 was down about 2.3%. These are large, sharp cuts coming through, but I mean, keep in mind when you look at these cuts that the market in India is already about 10-11% off from the all-time highs. In the US, I mean, we've barely scratched the surface in terms of any correction. So that's a big difference here when you try and extrapolate some of this to what's likely to happen here. The wicks went past the 20 briefly, but then kind of settled under it. The 10-year, again, bond yields across the board, you look at the 2, the 10, actually the front end, the 2 and the 5 were the ones which saw, 12, 13 basis point moves, but the more tracked 10-year was up 7. The 30-year yield in the US went up above 5% for the first time in over a year. So just some action in the US rates market across developed markets. And, a case in point, of course, is the UK, which is seeing another big blowout move in yields, largely because of the fiscal problem. Yields across developed markets last week up between 17 and 25 basis point. So this is largely a problem with regards to, two things. One, US is kind of running ahead of everyone else. And of course, the second is that everywhere deficits and debt, etc., are mounting, especially in the face of slower growth. And once again, I go back to making that point with the help of the UK. Dollar index, 109.65. You have and of course, the other one is oil prices, which is also important for India. So we left off just under 80, but this morning, I think oil prices have surged a little bit more. So we're now talking about between Friday and today, this morning, we're talking about almost a 5% move, and we'll talk more about this as we kind of go along. If I can just quickly put out the dollar rupee as well. The dollar rupee has actually gone past 86. So it happened after India equity close on Friday. So we left off at about 85.9650, but it went past 86 onshore, and I think went up as high as about 86.10 or so. So keep an eye on the currency here in India as well as we trade start this morning. Now, just to tie in the levels, Nifty, it's closed below the critical support zone of 23,460 and 23,500. What are we looking at? November lows, which is 23,263. That's the next big number in that sense, which kind of comes into focus. It's some distance away. So, but you start to imagine a market where probably we kind of get to that eventually, unless and until things start to reverse very quickly globally. Resistance comes in at the 40-hourly exponential moving average, which is 23,625, just 200 points away from where we left off on Friday. Bank Nifty support comes in at 48,264. So that is about 0.7% away. And the Nifty Bank resistance, again, is the 40-hourly exponential, 49,768 is where we are looking at. So those are numbers and levels. For the day, just for the day, it is possible that in the first half, there is, of course, going to be that reaction to the Fed, etc. But we've seen this many times play out, especially after the jobs number, specifically after the jobs data, and maybe after other data points as well. When the market here has already, in a way, come in, has been correcting and gone into a data point in a very corrective kind of fashion, the second half turns out to be a little better. So let's see if that indeed is possible. But I think in the first half, because of the way the market has been trading and the sharp gap down, there perhaps will be some margin requirements, margin calls, etc. And maybe the second half may be a little better. But 180 points is going to be a slam dunk open on the way down. Surabhi.
Absolutely. So we've got plenty of headwinds in terms of international markets, and Asia right now is trading down anywhere between 0.5% to almost 2%. The Japanese markets are short. The one that's falling the most right now is the Hong Kong market, which is down nearly 2% as we speak, thanks to the shocker of the non-farm payrolls report. And the expectation was 155,000 jobs will be added. What actually was added was 256,000. So the beat was a substantial one, which is why we had that move across asset classes, with US yields now being at the highest levels that we've seen in the last 14 odd months. By the way, if you're looking at the rate cut probabilities, then the probability of zero rate cut in the January meeting, which is coming in on the 29th, is as high as 97%. The next meeting comes in March, and there also the probability of no rate cut is as high as 78%. So a lot of this pushback in terms of market expectations on lower rates, that's all getting priced in, and it's been painful, in terms of the asset class moves as well. On oil, I just want to talk about this move that we've had. 5%. 3.5% on Friday, another 2% this morning has taken Brent above 81. So what's the issue? US has imposed sanctions on a whole host of Russian entities, Russian oil companies, their executives, and more, oil tankers as well. And this includes entities like Gazprom. Even Gazprom's CEO has been sanctioned. And a lot of the Russian tankers that are ferrying oil, bulk of them have been coming under sanctions. So there's worry about what this means in terms of the immediate reaction in oil supplies in the market, because Russian oil is going to be pushed back, which has caused this move. We'll talk about this with Manisha as well as we go forward. Along with the non-farm payrolls report, there were two other data points that were weak in the US. One is the consumer sentiment index that missed the mark for January. And then the University of Michigan does the inflation expectations survey. And the one-year inflation expectations have surged up to 3.3% in the latest print versus 2.8% in December. And even long-term inflation expectations are the highest they've been since the GFC, the global financial crisis, descended upon the world in 2008. So inflation is a big bothersome point, which is why we're seeing the kind of moves that we are in asset classes. Now the silver lining. Here at home, IIP has actually improved to a multi-month high. We haven't seen these kind of numbers in the last 5 months. 5.2% is the November print coming in, and the improvement is across the board in the electricity output, in mining, in manufacturing. In fact, the capital goods output is at 9% in November versus 3% in the previous month. So this is the good news, but is it going to be enough? Fund flows, it's the same story. We sound like a bit of a broken record, but then that's how it is. Once again, FIIs on the sell side, they sold off equities, cash equities worth about 2,200 crores. Domestic institutions have been buying 3,900, but it's not enough because apart from the FPI selling, there's obviously a lot of selling at the direct retail level, perhaps selling at the at the level of family offices, etc., and the HNI segment, which is responsible for what we've been seeing. Lots of stocks are going to be in focus. Earnings season has started. DMart has reported numbers. The revenues are looking good. For Just Dial, I mean, it's a mixed bag, and we'll talk about it. Oberoi Realty is interesting. They're going to be developing a very large parcel of land in prime, Mumbai suburbs in Bandra. It's a slum rehabilitation project, so watch out for this one. And there's good news for Biocon coming in for their Malaysia facility from the US FDA. Today's result tally includes HCL Tech, Anand Rathi Wealth, Angel One, Delta Corp. So lots of stock-specific action. But Nigel, it's this big slam dunk, the global slam dunk that we have to deal with first.
Well, that's right. I just want to tell viewers out there, investors out there, that sometimes these kind of periods are the best opportunity to build a portfolio for longer term. So don't lose heart on that fact. For the day itself, well, the GIFT Nifty, that's the suggestion that we pull back closer around 180 to 200 points. So clearly, it's going to be a weak start. And the troika is against us. Crude prices are higher, the dollar index is stronger, and yields as well have moved up. So the troika is against us, and that's why we're likely to start off very, very weak. The FI net short positions, well, that's moved to the highest levels we've seen in multiple months. So that from the start of the week at around 2.2 lakh contracts on the short side, that's moved to around 2.8 lakh contracts on the short side. And guess what? The clients, they have in fact adding long positions, and they're adding into this weakness. Because from around 2.5 lakh contracts on the long side, now they're moved to around 3 lakh contracts. And this is the highest that we've seen all the way since the election verdict day. At that point of time, remember, the markets were a little bit jittery, and the long positions at that time were 3.3 lakh contracts. So similar case right now, lot of pessimism, but the clients, they are net long on the index. Let's see whether or not they get it right yet again, because in June, they were bang on and we saw a big recovery from the lows that we saw out there. 2 strikes active, 23,500 called, 23,400 put. Both of them come up for you on the screen with premium at around 130 to around 140 rupees. Now the lows need to be protected. And the recent reference low that we have is roughly around 23,250. Going by the options data, going by the technical levels as well, that 23,250 level needs to get defended on a closing basis. So that's the level we're talking about. The November lows, you don't want this level to break out. And otherwise, the recent reference points that you have for you on the screen, we're likely to break the Friday's low as well. But you don't want to break that 23,250 to give the bulls some kind of a hope to fight back, because the odds are stacked against them. But many a time we see that if some kind of glimmer of good news can lead to a bit of a short covering bounce, and that's the hope. The problem is the Nifty Bank. That's been making lower highs and it's been making lower lows as well. So you'll want this trend to reverse. Those are the highs of the Nifty Bank. You'll get the lows as well. Both of them, lower highs, lower lows, not a great sign technically. And this one needs to get its act together because it's been the big underperformer. Since crude oil prices have spiked up because of potential lower supply coming in from Russia as well as from Iran, well, you have ONGC and Oil India. They could be the stocks to focus on that crude play. So we start off in the red, but don't rule out a fight back at some point of time. The structure is weak, but a short covering bounce is very much new.
Okay, let's see how this plays out. Gearing up for a bit of a rough start. On equities, Chetan Seth of Nomura says the strong non-farm payrolls print on Friday will not come as good news for Asian stocks as it further drives up the dollar and US bond yields. And the market is increasingly pricing in a long pause from the Fed. He thinks investors need not be overly pessimistic, though, as an opportunity to raise risk exposure might emerge sometime during the year when markets reach peak pessimism and the specter of tariffs is behind us.
Okay, this is the economist from Citi who weighs in next, and he sees the next Fed rate cuts as most likely to be delivered at the May FOMC meeting. He says a March cut is possible if labor market data weakens sharply, but Fed officials might wait until June and then cut rates at a slower pace if the unemployment rate remains 4 to 4.2%. He says they are not particularly concerned about scenarios in which the Fed does not cut this year or considers hikes.
Michael Ferroli of JP Morgan says that they now look for the Fed to hold policy steady until June, then cut twice this year, also in September, to bring the target range for the policy rate to 3.75 to 4% by the end of the third quarter of 2025.
All right, so that's the backdrop, right? I mean, it's clearly negative and it's clearly looking all red across.